Where does your money go in a recession? Imagine waking up to headlines screaming, "Trillions vanish overnight" as markets crash. Your stomach drops. Where did all that money go? Did it evaporate into thin air? The truth is more intriguing than a magic trick. In every recession, money doesn't disappear. It simply moves, shifts, and sometimes hides. Today, we're uncovering that mystery. By the end, you'll see recessions not as money-eating monsters, but as reshuffling storms, and learn how to weather them. The reality, money's great disappearing act, and the truth behind it. When the economy takes a plunge, it feels like someone waved a wand and made wealth vanish. But think of money as trust and promise, not just paper or digits. Money is really a claim on value. In a panic, prices and account balances fall, but the underlying value often remains. For example, during a crash, your stock portfolio might shrink on screen, but unless you sell, those dollars haven't left the system. They're just waiting. It's like a sale at a store. Prices drop, but the product's value still exists. In recessions, price and value diverge. A company's share price can halve in a day purely from fear, even if the business itself is still fine. In 2008, the S&P 500 lost 38% of its market price, yet most companies survived. Meanwhile, assets like gold, which hold perceived value, often surge. This shows that money's position has changed, from panicked sellers to calm buyers. Recessions don't destroy money. They rearrange it, like redealing cards at a poker table. The total chips are mostly the same, but who holds them and how many each gets changes. Now imagine the economy as a giant dance floor. In good times, money, the dancers, moves quickly, twirling from one partner to another. In a recession, the music slows and many dancers freeze. The money hasn't left the hall, it's just paused. By mid-2020, economists noted the velocity of money, how fast each dollar changes hands, plunged to historic lows. Each dollar circulated far less as people stopped spending. This slowdown is like hitting the brakes on a highway. The cars, money are still there, but traffic grinds to a crawl. The Great Freeze, when everyone hoards cash. When fear hits, people instinctively hunker down. Instead of spending or investing, many start saving. During the 2020 recession, American workers went on an unprecedented saving binge. By April 2020, the U.S. savings rate jumped to a record 33.7% of income. That's roughly one-third of every dollar they earned. It was quadruple the rate from just months before. This reflects a simple panic reaction. If jobs feel threatened and the future uncertain, why spend money? This behavior is like squirrels hoarding nuts before winter. The result is a freeze of spending. People held onto their dollars, stuffing bank accounts or sock drawers. Think of each dollar as a hot potato. No one wanted to hold it for long, but suddenly everyone did. When spending falls sharply, stores earn less, companies see revenues drop, and prices can even fall. The economy, which thrives on exchange, becomes stagnant. For the velocity of money, this was dramatic. The Federal Reserve and economists saw that each dollar was being used fewer times per year. Picture a coin that usually passes through 10 hands a year now being passed only twice. That's what happened. With so much cash parked on the sidelines, it appeared missing from the economy's busy center. Safe havens and passive zones, where money hides. So if people were saving like never before, where did that cash go? A lot of it found refuge in so-called safe havens and parking lots for money. High-yield savings accounts, money market funds, and short-term government bonds suddenly looked attractive. These became passive holding zones, places where you store cash to wait out the storm. For example, many Americans deposited extra money into bank accounts or treasury bills, which at that time offered a few percent return. It's not sexy, but it's safe. There were also hard assets, things you can hold or see. Gold is the classic example. During the chaos of early 2020, gold prices jumped 24%, even as the stock market was falling apart. People always buy gold when they fear paper money might lose value. Similarly, art antiques, or real estate, especially farmland and housing in stable areas, attracted buyers with cash to spare. These are like heavy anchors that hold value. When the paper waves get choppy, investors step aboard. Meanwhile, look at companies. Some industries become money magnets. In recent years, tech and biotech often defy recessions. Think of a company like NVIDIA, maker of computer chips. Even as some parts of the economy stumbled, demand for technology like AI kept interest high. At times, NVIDIA's stock soared even during downturns, though it also experienced volatile dips. In general, sectors like healthcare, utilities, and essential consumer goods tend to attract money when fears run high because their business models aren't as affected by cutbacks. Investors move their dollars into these safer, steady sectors, pulling funds out of riskier industries. In short, money retreats into safe harbors. The wealthy often park in municipal bonds or luxury assets. Banks and treasuries hoard reserves. And central banks themselves can be seen as big repositories. When the Fed printed trillions to fight the slump, it meant new money flooded into bonds and bank reserves waiting to be spent. The market roller coaster, winners and losers. Now, let's follow what happens on the market side. Stock prices are perhaps the loudest signal of a recession. Headlines talk about billions wiped out, which sounds scary. But in truth, those are paper losses. If you didn't sell your stocks, the money is still accounted for. It just reflects lower valuations. Imagine two friends, Alex and Priya, each holding $1,000 worth of stock on January 1st. If by April their stocks dived to $500 on paper, it looks like $500 disappeared. But that money didn't vanish. It means if they sold, they would have gotten $500 less. If they hold on and the market rebounds later, that value returns. Recessions often see wild swings in stock prices. For example, during the 2020 crash, major indexes fell nearly 30 to 35% in a matter of weeks, then later recovered much of that loss by year-end. That ride illustrates the volatility. One day, a stock like Tesla might lose 20%, and a few months later bounce back. The money flows reflect sentiment, earnings outlooks, and broader policy moves, not literal destruction. And it's not all gloom. While many companies suffer, others find new opportunities. Downturns can expose overvaluation, letting smart buyers snap up bargains. After the 2008 crisis, companies like Uber and Airbnb were born. After the 2000 dot-com bust, Amazon and eBay rose to dominance. In the 2020 downturn, Zoom and Peloton became household names as needs changed. The money that fled fading businesses often found new uses in startups and innovations. Importantly, during crashes, someone usually buys what others sell. That's part of the rearrangement. A mega investor might scoop up a hot tech stock at half price, injecting new money there. The media may say trillions wiped off paper, but in reality, those losses are gain opportunities for others who have cash ready to invest. Wealth shifts hands, sometimes from worried retail investors to those with the luxury of patience and planning. Inflation and government, the catch-up phase. After the dust settled, the story of money isn't over. Governments and central banks often print new money to stimulate recovery. Remember the billions sent as stimulus checks and the Fed buying bonds. This adds dollars into the system, aiming to restart spending. At first, it prevents a deeper crash. Later, it can fuel inflation as too much money chases too few goods. So, post-recession, many people find their dollars don't buy as much as before. In effect, money's value is diluted by inflation. But again, where did that money go? Part of it circulates through bailouts, jobs, and infrastructure. Another part flows right back into markets, sometimes overheating them. The key point, the balance shifts again. Take control and build wealth. So what can you do with this story? First, don't fear recessions. Understand them. Knowing money doesn't vanish but relocates lets you act smarter. Keep some cash or safe assets to sleep well, but also stay invested or invest wisely to ride the rebound. Recessions often weed out risky ventures, but for prepared and educated people, they are also springboards. Use this time to boost your financial literacy. Learn about investing, budgeting, and entrepreneurship. Every crash has winners. They are often those who saw the game was changing. Maybe it's time to start that side gig you've been dreaming of, or take a finance course, or finally open that investment account. Remember, giants like Airbnb, Tesla, and Google grew out of economic hard times by offering something new or essential. You can find your own way to serve others with value, and in turn catch the flow of money as it shifts.